Ken, the FX Freak, is back to talk all things rate hikes. Will they, won't they, have they? Let's find out. Ken, it seems Trump has not slowed down with his tariff plans. What do you think's next?
Mr. Donald Trump, so really no slowdown for him, continue to dominate the headlines across the board. So in his latest stunt, he's announced $60 billion worth of tariffs against another huge economy, China. So these are the two biggest economies in the world going head to head with these trade wars. Donald Trump was, in his wording, he actually said that there's an intellectual property theft going on. In other words, hundreds of billions of dollars, and noting that these two have the largest trade deficit in the world, and he's something that he really wants to crack down on, as we've seen him speaking over the last few weeks with his intentions on these tariffs. So big bold move there from Trump, but not to hold back, China have already announced that they're to take action as well, introducing $3 billion of tariffs against the US in the likes of sort of pork and also steel imports. And essentially 25% tariffs on US imports in general. And essentially that is quite reserved for the time being, one would think. But it looks like China may be calculating and seeing how further to potentially hurt the US as much as they could be hurting China with these tariffs, essentially. So some big trade wars going on. What does that mean for the dollar? Well, the dollar is weighted across the board against against its peers, and I think this is likely to continue to hurt the dollar in the short term. So keep an eye on that, and depending on how heightened and how far these wars potentially go, could continue to dampen any upside for the US dollar. So keep an eye on the developments for that.
The Federal Reserve raised rates for the first time this year. What do you think their next move is?
Yes, so it was Mr. Jeff Powell's first rate decision as the chair of the FOMC, and they did hike rates by 25 basis points then. In terms of some of the rhetoric, they're upbeat on growth for the US, upgrading their forecast, and they're actually seeing a further improvement in the labour market as well. That's to say that it isn't strong enough as it is, but they're seeing the unemployment rate continuing to tick lower, which is good. The only downbeat thing I'd say was inflation forecasts remain pretty much unchanged. Didn't see much change there. And as we know, and I've said on a number of occasions, they're suffering with still stubbornly low inflationary levels in the US. So that's something they really need to think about going forward with their wanting to tighten up policy. The dollar weakness did come actually on the back of this decision, because the dot plot indicating that there may only be 3 hikes. Markets were starting to get happy or price in potentially up to 4 hikes, but that might not be the case. It's very much going to be data dependent, and inflation being a key one to watch, guys, as well as wages in the US. So in terms of when next hike, it looks to be in the summer of this year, in the next couple of months or so. So keep an eye on that. That looks to be priced into the markets.
Finally, keeping on the subject of rates, the Bank of England kept rates unchanged. What was said along with this decision?
So no change from the Bank of England at this meeting. We did actually have 2 dissenters that wanted a hike for this month, because their concerns are about inflation remaining far too above the Bank of England's target, and they believe if they don't start raising now, if they leave it too late, this could become a problem and force the Bank of England to act a lot faster than the markets would like to see in terms of raising of rates to try and cool down that inflation. Nevertheless, though, a rate hike does pretty much look set, as they've indicated, for the next time they meet, which is in May. But they have given themselves a little bit of wiggle room, and essentially it's going to be very much dependent on data. We've already had one checklist off the Bank of England's target, and that essentially was on the Brexit situation, and we have seen progression with that. We had an agreement between Britain and the EU with the transition deal, which is good. But now what we need to look at, and markets need to be aware of, that's going to continue to support the pound as the market prices in a hike for May, is data such as GDP, the employment figures in the UK, wages, consumer spending, retail sales, These are all key numbers that you need to be wary of, and that's likely to support the pound as long as those come in and look healthy for the UK. So those are very much dependent on the next rate hike. And for the pound, I continue to see some good upside, particularly against the dollar with all that's going on with Trump and tariff, etc. In my eyes, I'm still looking at 145 potentially and beyond over the coming months.
Well, a big thanks to Ken, and thank you for watching. If you like this interview and would like to find out more, as well as watch much more content with Ken, the FX Freak, head over to dukascopy.tv.